Hello everyone, this is Mulham from Mulham Trading. Today I'm giving you a full guide on a draw on liquidity. This is one of the must learn concepts when it comes to ICT or SMC. If you master this concept, and I'm sure you will, you'll be able to predict where price is going to every single time. You would know where price is going to, and from that point, where is it going to after. If you watch other videos on draw on liquidity and you did not understand, on this video, I promise you will. I'll break it down into multiple parts and I'll go over examples to make it clear. If you guys appreciate this type of content, then make sure to subscribe to the channel, hit the like button, and leave a comment. If you need a private one-on-one mentorship, make sure to check the description. For now, let's get into it. Before we dive into today's video, if you're looking to secure up to $4 million in trading capital, look no further. Bespoke is one of the best platforms in the industry now. Trade at your own pace with no time limit, very low spreads and slippage, request a payout in 14 days and get it in less than 24 hours, balance-based daily drawdown, and much more other features. For a special 10% discount on all accounts, use code MULHAM at checkout and find all links in the description. Let's continue. So starting with what is a draw on liquidity. It is expecting where price is likely going to based on liquidity and fair value gap. And in my opinion, this is the most powerful skill to have compared to all other ICT concepts. After this video, you'll be able to expect where price is going to. And if price is going higher, where is it retracing to before going higher? And the same for lower. If price is going lower, where is it going to retrace on the upside before going lower? So you'd be able to predict where the market is going to, and you'll be able to catch some good trades. Now, what makes the market moves? Okay, there are only two things that the price or the market does. It's either rebalancing fair value gaps or seeking liquidity. Those are the only things that price does. If you understand that and apply it to the chart, you'll be ahead of the game. Let's take a look at this example here. On this example, what do we see? Price going up, coming down. We had a fair value gap here. What happened is price came to fill this fair value gap, but at the same time went down to take this external liquidity. After seeking this liquidity, it went up to rebalance or fill this fair value gap. This is the cycle of the market, rebalancing fair value gaps and seeking liquidity. Now, when it comes to our liquidity, we have external and internal. And in order to understand this, let's imagine we have this price action leg here, or we can call it a price range or dealing range. So we have this price range here, a high, a low. Those highs and lows are our external liquidity. So external liquidity are the highs and the lows in our range. When it comes to internal, what is inside of this range? Most likely, if we just determine our high and low, what is in between? There is nothing in between except fair value gaps. A fair value gap and a fair value gap. Now, if we go back to this example here, in this price action leg, for example, what is in between? We only had fair value gaps on this price action leg. What did we have? Only fair value gaps, and then we have the high and the low. Those are our external, and our internal is the fair value gap. So you should always remember external highs and lows, internal are fair value gaps. Now I know sometime if you go to the lower time frame, you would be seeing a lot of fractal highs and lows, equal highs, equal lows, whatever. But if you go to the higher time frame, you would see them as a fair value gap. So always know this, fair value gaps inside of this price action all the time. Now, after we understand what is internal and what is external, price only moves in two directions. And this is what I do every time when I teach someone. I teach them how the SMC or the ICT or the market in general, how it moves. And this is the same as continuation and reversal. It's the same as a breakout structure and a liquidity sweep. And it all revolves about external and internal. So price only moves in two directions, and they are external to internal or internal to external. What does that mean? From a high to a fair value gap, or from a fair value gap to a high or low. If we take a look at this diagram here, we have our external range right here from this low to this high. What happened after this? Let's imagine that there was a liquidity sweep just before. That's an external liquidity sweep, right? Price will go to an internal, which is a fair value gap. And from an internal, where are we going? So if we are here, we're going to the left and it is external. So we're going from a fair value gap from internal to high or low external. And this is what happened. Now after external, what is going to happen? We are here external, we're going to the right, we're going to internal, external to an internal fair value gap. Now in this case, when we are on this fair value gap, we are going from internal to external, right? But we have this external and this external. Why? Because this is our price leg here, or price range. Is it going up or down? We're going to answer this question on the next slide. Now, the same diagram here, what do we see? We see price going up, coming down, and as we said, here there was an external liquidity sweep. Where are we going? Internal. From internal, we're looking for external, but is it the high or the low? And the answer for this question is kind of tricky, but it is the order flow that was happening before, or your bias on the higher time frame or in the same time frame. But if you zoom out and you see that price was coming down all the way right here, then you're expecting a break of structure to the downside. So most likely price will continue to the downside. But if we are coming from down here and price was going up, 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 and this is part of the move to the upside, then we are expecting price to come to this fair value gap and then give me a break of structure on the upside here. Okay? Now, what is another thing that determine if we're going up or down? It's displacement. So when price reaches this fair value gap, I would like to see a displacement either to the upside or the downside, and from there I'll determine if I'm going up or down. So if I see a displacement to the upside, from here there was a reaction, then I would know that, okay, most likely we're going to this external. However, if price displaces below this fair value gap and doesn't respect it at all, then we're looking to go down. And this would be your take profit. Even if it goes lower, you're still taking some profits here. One more thing that can determine this is also the weakness or the strength of the candle. So if you get a kind of an engulfing candle here, you would know that, okay, most likely we're going up. But if you see some weakness and there is no retracement, there is no hint of reversal, then most likely we're going down for this external, for the low instead of the high. So order flow, displacement, weakness, and strength of candles, this is what determine if we're going up or down from here. Now you need to decide. You need to train your eyes and see which type fits you better and it's easier to spot. So you'd go to the chart, you would try to apply all of this and try to see, do you see the external to internal easier, or do you see the internal to external easier? Based on that and based on your backtesting, you would know which one to trade, either one of those or both of them. Most likely, and what I like the most, is external to internal. It's easier to spot. And most of the strategies that I uploaded, especially the 4-hour sweep, for example, it is external to internal. So it's kind of easier. It's just liquidity sweep. And then we go to internal to target. But if you prefer the internal to external, then that's also good. Now let's cover some examples. I'm going to go to trading view and show you some examples. Now let's cover some examples. Let's assume that we are starting from here. You can start from anywhere and you would see that it all works anytime. It can get tricky sometimes. Price, sometimes, it doesn't take the external, or it takes a very previous external and then goes to the internal. You don't see it. But I'm going to go over this example very quick and then maybe cover some other examples on other pairs or instruments. For now, we have Euro USD, the daily chart. What do we see here? Let's consider this price action leg, okay, this one. If I zoom in, what do we see? So we have this leg, we do have an external here and an external here. What happened is price takes this external right here. When external is happening and we already know price is most likely reversing, why? If you can see here, it's literally a sweep and then price going up back into the range very aggressively. So we know that price is now going up. Now we do have this range, okay, price action range. Now we're going from external to internal. So to this fair value gap and this fair value gap. We have two fair value gaps, this one, and price is going there. So after here, coming to this fair value gap, we can see that there was a displacement above this fair value gap. So most likely price is going higher. There was an inducement here, however, price still keep going up. So we're looking for this to be filled. And what happened is price filled this fair value gap and then started to go down. So at this point, what are we looking for? We're looking from internal to external. So we should be changing the bias from here to go lower. Okay, and to this point. However, it doesn't happen. It only goes down here and then started to go up. It happens sometime. You want to be realistic. You don't want to, let's say you enter a trade here on the, let's say the 4 hour or the 1 hour, for example, here, and then you have a stop loss above this high, or maybe somewhere in here. You don't want to target this low for 8.5, especially that this low is already taken. It's a very strong sweep, so you should be kind of realistic with the profit. Let's say 3 to 1, 4 to 1. It's so good, and you see that you predicted the right direction. And that's the thing we're looking for. We are predicting where the market is going. We don't want to catch the lows or the highs, or we don't want to catch, let's say, 10R or 20R. We are really looking for a bias to target. So price is going down, and then there was a low here that was taken. If we consider this as our, because price did not take this external, if we consider this as our external range, okay, from this high to this low, we can see that there was a sweep here. So now price is moving from external to internal, and in this internal price range we have this fair value gap, and we also have this one. So when I have some strength on the candles, I would know that, okay, most likely we're going up. And after this candle, or even weakness on those candles, it also tells you that, okay, price is going up. We can see that price filled this fair value gap and filled this fair value gap. So after that, we're looking for external to be taken, either this low or this high. And we can see that it's actually this high that was taken right here. And after this candle, you would know that, okay, most likely we're going down. To where? To this fair value gap, internal liquidity. And there must be a fair value gap on the lower time frame here, maybe on the 4 hour, but not on the daily. Price came to internal. We should know that, okay, most likely price is going to external again. And where is my external? Now, this is my last price action leg, right? This is the low and this is the high, external. Now price takes the external here, and then where is it going to? We were expecting price to go to this fair value gap. However, it doesn't go. It doesn't happen every time, but price goes up. There was no weakness at all. All of those candles are very strong. So I'm not looking for, price to go lower. Now, when I see this candle and also this one, if we zoom out, there is already an external on right here, right? There was a sweep. So we know that after this external on a previous high, we would know that, okay, most likely price is going to fill this fair value gap, which is internal. And after this internal, we're going to where? We're going to external. And where's my external? Right here. This is my external now. And after external, what are we doing? We're going internal, which is this fair value gap here. Fair value gap. After this internal, where are we going to? External. And where is my external? It's right here. And the cycle goes and goes. It kind of gets complicated sometimes. If you just know how to define your price range and your external liquidity, you would be able to master this. Now, if we go and take a look at another example, which is NASDAQ 100, I'm just showing you how I look for draw on liquidity, how I decide where to go to, okay? So let's take a look at this example, and let's start from the top here. What do we see here? There was a clear liquidity taken, external liquidity, right? Right here. External liquidity taken, this high, and this high into a fair value gap. So that's a good thing to see, right? A sweep into a fair value gap. Now, if we zoom in right here into this price action, where is the last leg that caused this sweep? It's definitely this, from here to here, right? From here to here. After this external, where are we going to? We're going to internal. And in this price action leg, there is nothing to look for or to notice except this fair value gap. This is the only thing that you see in this price action, and this is where you're expecting price to go to. And price eventually go to this fair value gap. From this fair value gap, you're expecting two things to happen. Either price to go up, take this external, or price to go down and take this external. So either up or down from this point. And if you see some sign of reversal, then you go up. If you see no sign of reversal, you go down. And this would be your drawn liquidity, either this low and this high. Why? Because we are going from internal to external now after going from external to internal. Now let's see what happened. Price did go down. Okay, if this fair value gap is not respected on the lower time frame, then you would know that your drawn liquidity is this low now. And after taking this low, after taking this external, what are we looking for? As simple as this. As simple as this. Taking this low, we're looking for external to internal. So what is internal in this price action leg? We have this fair value gap, and we also have this fair value gap. What happened is price went to this fair value gap and almost to the second one into this volume imbalance and started to go down. So we did have internal, and then we're looking for external. Now price is starting to go down, so we'll be expecting price to give us a break structure to the downside. Okay, most likely. Now price went from internal here to external, taking this low. At this point, what I'm looking for is for price to go from external to internal. And this was your fair value gap here, from here to here. And that's what happened. Price went to internal and then started to go down lower and lower. Now from the previous price action, what do we see here? We can see there was a low here, an external liquidity, I'll say maybe a month ago. Okay, so this is a low, an external low we should consider. Price came to that external. What are we looking after? After external, we're going internal. And if you notice on this price action from here all the way to here before the sweep happened, or just when the sweep happened, there is no internal liquidity except this fair value gap here in this price action leg. This is the only internal liquidity. And what happened? Price went from external to internal right here into this fair value gap. After this internal, if you take a lower time frame entry here, what are we looking at? We're looking for price to go from internal to external. Where's my external? It's this low. And that's what happened. It came down into this external. And then after this external, what happened? Price came again into this internal, go internal, and then started to go down for another external. This is the cycle of the market. Make sure to understand, make sure to watch this multiple times to understand it. And now let's go back to the slides. So now after taking some examples on how to find your drawn liquidity, we're going to try to put it all together on how to enter trades or how to actually take advantage of this. Here are two time frames that you can use, or maybe if you use another time frame, just use the same logic behind those time frames. So if you use the daily for your drawn liquidity, you can take a trade on the 1 hour. If you take your trade on the 15 minutes, then you can use a 4 hour in order to have your drawn liquidity. Let's imagine price was going external liquidity taken. Now we will know that price is going to internal. Now this is the 4 hour time frame. Inside of that sweep, we're gonna go to a lower time frame and we're gonna use any lower time frame enter setup. I do have a lot of setups or strategy on my channel. You can pick any of those and then enter on the 15 minutes, targeting your draw on liquidity on the 4 hour. and that would be giving you a good reward to risk. That's the first thing. Now, if you're going from internal to external, you do the same thing. But the first thing to do here is to decide if you want to go from external to internal or the opposite from internal to external. Just based on that, go to the lower time frame, find a setup, and then your draw on liquidity would be clear, which is your take profit. That's it for this lecture. I tried to make it very straightforward and simple. You guys make sure to join my Discord. If you need help privately, then you can check the description for a one-on-one mentorship. Hit the like button, leave a comment, and subscribe to the channel. And that's it for today. I will see you in the next video.